Income tax 2020. Adjustments to income, student loan interest. Come in, relax with income tax 2020. Adjustments to income, student loan interest. When thinking about our income tax equation, we're basically going to be on the second line here. We can think about our income tax equation as having two halves to it. The first half being the modified income statement, second half being the calculation and application of the credits and payments to get to that tax refund or tax due, the bottom line. We're going to be focusing up on the first half here. Prior section, we looked at the income. Now we're looking at the adjustments to income. These could be referred to as the above-the-line deductions, the Schedule 1 deductions, the deductions for adjusted gross income, or adjustments to income. So whatever they're going to be referred to, we're talking about these ones up top. I kind of like the above-the-line deductions. It's the easiest or fastest one to say or Schedule 1 deductions, but we're not completely sure Schedule 1 will be remaining around. Therefore, above the line kind of works for me. But in any case, we're up in this section. We're going to be focusing in then on the student loan interest. Now, student loan interest will typically be a case where someone had, they had a student loan, and now they are no longer a student, most likely, and they're paying back the loan at this point in time. Student loan interest will typically be indicated by a 1098E. So we're not talking about a 1099. When you see a 1099, your thought is usually that, okay, this looks like something that might have to be included in income. A 1098 is going to be a form of documentation, but this one's going to be indicating that this may be something that could be used for a deduction in this case. So student loan interest may be something that could be used for a deduction, a 1098E. So if you see a 1098E, while filling out or preparing tax returns, that's where you're thinking about putting it in that basically above the line section into the Schedule 1 type section. So we'll talk a little bit more about the requirements, but that's the general concept of it. We have here the student loan interest received by the lender. Now, most of the times, because these student loans will basically be loans that will be held by institutions, the institution will typically be good at then processing the 1098E and then providing to you. And once you have that, it should be a fairly straightforward transaction for the most part. If you have any questions about the 1098E, then of course you can look at the instructions, which should be given along with the actual form, or you can find these on the IRS website and just search the form, then look at the instructions related to that. The instructions will typically be in a box-by-box type of instructions as with previous forms. Now here's a look at the Form 1040. I know it's a little small, a little blurry, but I want to see the entire 1040 on the one page here. And so it's going to be included down here on line 10. And this 1,000 is being drawn from the Schedule 1. So here it is being drawn from basically the Schedule 1. We'll see this in more detail in a following presentation as we actually enter this into the tax forms using tax software. Then here's the detail of it. This is Schedule 1. We're on Part 2 of Schedule 1 here. And we're down here on the student loan interest. Student loan interest now being that 1,000 that carried forward to the 1040. Notice it's being pulled over to the top part of the 1040 here, and it's not going to be something that is subject to whether or not it's going to be over the itemized deductions. So the itemized deductions and the standard deductions will then be below this line item. So that's why you can think of it basically as above the line type of deductions deductions to get to the adjusted gross income here on line 11. So the data input should be fairly straightforward. Then you're going to have questions about if there's a phase out of the amount of the deduction and whatnot. You want to be able to know that so that you can discuss it. Also, if there is a phase out, like an adjusted gross income phase out, meaning this amount shows up to be less than what is actually on the 1098 form, then you want to understand that. So when you do the data input, you can understand what's going on. Why is the tax software limiting it? And then be able to, of course, explain that to a client. So student loan interest. Student loan interest is interest you paid during the year on a qualified student loan. It includes both required and voluntary prepaid interest payments. So typically it's on kind of a cash basis. If you made the payment, the amount applied to the interest. So in other words, you're imagining someone got a loan for qualified education. Now they're paying back the loan. They're not going to school anymore, most likely. They're paying back the loan that they had in the past, and they're paying interest on that. The interest is the portion that could possibly be deductible for the most part. we're looking at the interest that was actually paid, meaning cash basis. You basically paid the interest. You may deduct the lesser of $2,500 or the amount of interest you actually paid during the year. So there's a cap of that $2,500. So if they paid more than that in student loan interest, then you're going to see that it's going to cap, and you're going to be able to want to know that what that cap is and why it is why it has been applied. The deduction is gradually reduced and eventually eliminated by phase out when your modified adjusted gross income (MAGI) amount reaches the annual limit of your filing status. So in other words, as you earn more money, as your income goes up, you may lose, or you'll have a phase out until you eventually lose the ability to take the deduction related to the interest. So even though you have the form 1098, you put the 1098 in, then it may be phased out due to your income reaching a certain level. We'll talk more about what those levels are in the future. For now, just note this term here, MAGI, basically means adjusted gross income, AGI, and then we modified it for certain things that would be related to this particular phase out. So basically you're thinking, when you talk to clients about this, or you talk to people about this, you're basically saying, hey, look, when your income gets over a certain amount, it will be phased out. And the terminology you will typically be using is simply income as you talk to someone else. When you get a little bit more technical on your tax return, then you're possibly going to be using the term AGI. And we talked about the fact that the AGI, the adjusted gross income, is usually the income number that will be used for the phase outs. The AGI is after we take into consideration the types of deductions we're talking about here, which is the student loan interest, which is another reason sometimes we call these deductions as, adjustments to income, because we're going to use that phase out number, that AGI. Now, when we think about the phase out, typically you're going to be eliminating things such as this deduction that would be included, that would be called the phase out for it. So that's what the modified is. So really, usually, the modification is fairly small, meaning you would take the AGI possibly before the student loan interest. So usually the modification is fairly small, and you can kind of rely on the AGI as the number that you're going to use to determine whether or not the income is high enough to reach the phase out to see whether or not it's going to be reduced. When you're talking to clients, of course, then you're simply going to be using income, most likely, unless you want to get more detailed on the AGI or modified AGI. And then to get real technical on the actual calculation, of course, you're going to be somewhat dependent on the software. So if the software doesn't do what you would expect, then you're going to go back in and say, okay, is this modified, this M before the AGI, the factor that's kind of messing things up or making it not be what I would expect it to be. So just be aware that modified AGI basically usually generally means AGI, adjusted gross income, is going to be what you'll use for the phase-out calculations. Okay, you claim this deduction as an adjustment to income, so you don't need to itemize your deductions. That's going to be one of the big keys. It's going to be above-the-line deduction, Schedule 1 deduction. Therefore, if you get it, and it's not subject to the phase-out, then you don't have to have that itemized limit, meaning you don't need deductions that'll be greater than the standard deduction in order to get a benefit from it. Student loan interest, you can claim the deduction if all the following apply. You paid interest on a qualified student loan in the tax year. You're legally obligated to pay interest on a qualified student loan. Your filing status isn't married filing separately. So these first two, if these are met, then you will probably get a form for it, a 1098 form, because those were met. This last one here, notice that if you are married, we said that if you're married, then you typically cannot go back to single or head of household, but can only choose between typically married or married filing separate, unless under the legal circumstances you could basically say you were separated or something like that. So therefore, if you file married filing separately, the IRS is skeptical of many types of things and deductions. They may limit some of the deductions. This is one of them. You will typically not get the deduction. One of the reasons for that is because people might try to manipulate the phase-outs, the income phase-outs, when they file separately. So anything that has a phase-out to it to get the benefit of a deduction or a credit, the IRS is skeptical of someone married filing separately, seeing that they might be gaming the system to take advantage of the phase-outs and get more deductions than they otherwise should due to phase-out limitations. So you'd remove that. So your MAGI is modified AGI, adjusted gross income, is less than a specified amount, which is set annually, which we'll look at shortly. You or your spouse is filing jointly, can't be claimed as a dependent on someone else's return. So if you're claimed as a dependent or can be claimed, then possibly you won't be able to take the deduction then. Student loan interest. A qualified student loan is a loan took out solely to pay qualified higher education expenses that were for you, your spouse, or a person who was your dependent when you took out the loan. So so you can then have the dependent when the loan was taken out. Education provided during an academic period for an eligible student and paid or incurred within a reasonable period of time before or after you took out the loan. Now, again, if these things are applicable, then typically you'll get the form, the 1098, and the 1098 is an indication that that generally some of these things would apply. And if you have the 1098, then it's likely that some of these things would apply, and you'd be more likely to be able to take the deduction and enter that into the system. Student loan interest. If you paid $600 or more of interest to a qualified student loan during the year, you should receive a Form 1098E. So note, if you paid less than the $600, it's possible you don't get it. You might not get the 1098E, and you might want to look into it and make sure to the institution at that point and see if you can get how much interest was paid. Student loan interest statement, PDF, from the entity to which you paid the student loan interest. So here's going to be the table for the phase-outs. So this is the modified adjusted gross income, basically income limitations, the phase-outs. So filing status, married filing jointly. Phase-out begins at $140,000. So if you're married filing joint, if you have up to $140,000, then you should get the full amount up to the cap of $2,500 or the lesser of how much you paid. And then it starts to phase out up until you get to $170,000. If you have over $170,000, you're not going to get any benefit from the student loan interest. If you're qualified widower, then it's going to be the $70,000 to $85,000. Head of household, then it's going to start to phase out at $70,000. So if you have modified adjusted gross income, basically income, AGI in essence, of less than $70,000, you should be able to get the full amount of the student loan interest until it gets capped at this $2,500, and then it'll start to phase out until you get to $85,000. After $85,000, it'll be gone. You won't have it anymore. If you put it into the software, as we'll see in a future presentation, it just won't show up because the software is going to say, hey, look, you hit the cap. Single, you have the same thing. If you're single, you can take it up to $70,000, up to the cap, $2,500, and then it'll start to phase out up until $85,000. After $85,000 of income, you'll no longer get a benefit from the student loan interest.